Hey everyone, today we'll be walking you through sensitivity analysis in capital budgeting. This presentation will show you both quantitative and qualitative factors that can be used to evaluate risk and project decisions. And by the end, you'll see how managers use sensitivity analysis to make more informed choices that align with financial management goals. So a quick overview, we'll be going over the goal and functions of financial management, sensitivity analysis overview, both the quantitative factors and qualitative factors in sensitivity analysis, financial methods of risk evaluation, conclusion, and key takeaways. And finally, our references. So starting off with goal and functions of financial management, the main goal is to maximize shareholder wealth. This involves increasing firm value and generating returns for stockholders. Financial managers balance risk and return by assessing both profitability and stability of investments. This also ensures that uh, the company remains liquid and solvent, meaning that both short-term and long-term obligations, meeting both short-term and long-term obligations. Another function is to support long-term growth by choosing projects that align with strategy and company vision. And finally, financial managers ensure resources are allocated effectively by directing funds to opportunities that generate the highest value. Moving on to the sensitivity analysis overview. Sensitivity analysis is a tool used to measure the impact of uncertain values on project outcomes. It also allows to run what-if scenarios, such as a change in sales, if like sales skyrocket or lower, discount rates, and see how those shifts um, change. This helps identify which assumptions are like most critical to product success by focusing the high impact variables. Managers can anticipate where the biggest risks lie. And ultimately, sensitivity analysis improves decision quality by showing a range of possible outcomes instead of a single forecast. Moving on to quantitative factors. Several quantitative factors are central to sensitivity analysis. Sales volume fluctuations can directly change projected revenues. Variable and fixed costs are also important, as rising raw material or labor costs can shrink margins. Discount rates changes are often measured through the cost of capital and affect net present value and internal rate of return calculations. Projected cash inflows and outflows also matter because the timing and size of expected returns determine profitability. Finally, measures like NPV and IRR are tested under different conditions to guide go or no-go decisions. Moving on to the qualitative factors, these are important because numbers don't always tell the whole story. And market conditions and competition can influence project outcomes, especially during industry cycles or when new competition enters. Marginal expenses is another factor, since poor execution can harm results even when the numbers look strong. And policy changes can introduce costs or delays. And tech disruption is also an additional risk, as new innovations may reduce the value of an investment, especially with how fast technology improves. And finally, organizational culture and leadership risk tolerance shape how much uncertainty the company is willing to accept at the end of the day. Moving to financial methods for risk evaluation. There are both internal and external methods for evaluating risk in capital budgeting. Internally, managers can use scenario analysis, look at best, worst, and base cases, or even break-even analysis to identify critical thresholds. Externally, they may benchmark projects against competitors or industry averages. Ratio analysis is another method where liquidity, leverage, and profitability are compared. The weighted average cost of capital also plays a role since it adjusts expected returns for financing structure and risk. In more advanced cases, decision tools like profitability, disruptions, decision trees, and simulations can be applied to model uncertainty. So finally, in conclusion, sensitivity analysis overall strengthens budgeting decisions by identifying risks before resources are committed, and overall is just a great way to support businesses and increase long-term strategy by balancing profitability with sustainable growth. Here are my references, and thank you and have a great day.